Hi, everyone. Mike White here. Welcome to this week's blog post. It's really important with things that are going on in our industry that we, take a step back and pay attention to what's happening and understand that the truth and the math really matter now, maybe even more than just a few weeks ago. I mean, we've all seen the fact that we've gotten quite a jolt to the bond market uh, since late last week. The market's been trying to find a new level. We've had a significant drop in the bond price on the 30-year 2% coupon, which most of us are getting priced off of. Whether or not it finds its legs and rebounds, we had a little bit of help yesterday late afternoon, but the warning signs are out there. It was a pretty miserable 20-year auction. Inflation numbers yesterday morning were a little bit scary and shocked some people, which saw us, have to question what was going on. So we did get somewhat of a recovery, but it's nowhere near where we fell off of. But putting that into context, uh, you have to look bigger picture. And as mortgage professionals, we get rate questions all the time. And it's really important that we, put things into perspective so that you have access to good information. Do you have, a chart of, mortgage-backed securities over the last year and a half, 2 years, so that you can show people where pricing was and where things have gone and what has happened recently. And for many people that I've spoke to since last week, um, many of them have not seen the same impact of their pricing to what actually took place in the market. And many times that happens. Sometimes our pricing is overreactive to what happens in the market, and sometimes it doesn't react as much. So for some of us who have been around a while and have lived through movement in the rate market to the upside, and you have to remember there are a lot of new loan officers out there who've never experienced uh, a push up to the upside or a significant run or even a complete reversal. And I'm not suggesting that that's where we are, but what I'm suggesting is you do have to be aware that when you're getting this degree of fluctuation, when there is this much news in the arena, that you pay attention that there is pressure between pricing and inflation and all the other things that are going on. There may very well be a reversal of a trend, or there may just be this blip. But here are some things that I put out there for you guys just to remember as you move forward, because clients and our referral partners may get emotionally attached to rates. People do. We all know there's a big difference between 2.99 and 3%. We know there's a big difference between 3.49 and 3.5. We know that emotionally people get fixated with some of those numbers. So here are some things. There's just a couple of things that I wanted to put out there for you guys to remember. It's you don't control the markets. If a client didn't want to lock their loan, or they weren't locked, or they were waiting for the bottom of the market on a refinance, that was a risk that they took. It wasn't a risk that you guaranteed or insured, unless, of course, you didn't make them available to the information, or you told them that there was no chance that rates were going higher. And I have no idea why you would have ever said that. So the part is we don't control the market. The mortgage-backed security market is what it is. Pricing is what it is. You don't control it, but you do have information that can help them look at the situation and do something about it. And I think that's important, to do the math. Take a few minutes with the client and share actual costs in monthly payment, and do it in 25, quarter of a percent, movements. So if you want to do it at 2 3/4 and 3 1/4 and 3.5, or whatever it is, and show them what the difference is in the monthly payment. Emotionally, there's a huge difference between 2.75% and 3% or 3% and 3.25%. I get it. But on paper, it again, depending upon the amount that they're borrowing, it's not as significant as they would be attached to emotionally to the numbers. So you have to see the information and put it out there. The only way to overcome an emotional hurdle is with factual data and put it out there. The next thing is, share the effects with offsets and strategies. Maybe the borrower, borrows less money to keep that same payment. Maybe they bring more money to the table. Maybe they buy a less expensive home. Maybe they bring some of their money to the table and buy down the rate. There's a lot of different strategies. Maybe we change loan products. Maybe we go from monthly MI to a single pay premium. Maybe we change loan programs. Again, all potential solutions. But what's the real problem? Is that they're emotionally affixed to getting one number? Again, what can you do to help them through that? And we're heading into the spring buying season, and the velocity of transactions is only increasing. Many of the reports out there are sharing the fact that, houses that are going into contract in 14 days or less. So many of these deals are coming together, and if you prepare, you're able to go in there and lock for 30 days and close the loan and make people aware of what the deal is. And you know what? If over the summer or next fall or whatever it is, rates recede and they go back down into the low or mid twos or whatever the case may be, you can refinance them then. So the point is, it isn't over. It's a matter of things that A, are not controllable, and B, you're going to make payments anyway. And by the way, even though the interest rate may be a little higher, you're still seeing significant property appreciations in the markets. And last but not least, remember the conversation we had about the car payment, that $350 a month car payment, and either eliminating that car payment or paying down so it wasn't counted against them. And we talked about that $350 car payment being worth about $70,000 in mortgage purchasing power. Well, we can do the same budgeting. We can look at those arguments and make the same case about how do we make that new higher payment work? What are the things that can be reduced or eliminated that we're willing to trade off if we want to borrow the same amount of money at a slightly higher cost? And again, by doing the math, they'll see this. So we don't know where this ride is going to take us, but please don't predict the markets. None of us know where the market is going. None of us are going to accurately predict the bottom. Nobody ever knows the bottom or the top of any market until well after it's long gone. But your ability to share real-time information and what it means is priceless. So get your charts ready, get the real information ready, get people accustomed to the fact that, again, we've seen volatility in this market, and some of those changes are not as significant as people think, even though anybody who is in the twos who now has to look at three emotionally is, oh my God, I missed it. Well, missed what? You're going to get a house. You're going to get a payment that you're going to be able to afford. And, it's going to be better than roughly half the people in this country who have interest rates still well above where rates are today. So think about that. There are people who are getting up, going to work and paying their bills. More than half the people in this country have loans where the rates that they're paying on their mortgages are higher than where you are right now. So watch the markets and pay attention to your own company's pricing, because every company reacts differently with this information. But be honest and provide options. Don't be the person who sticks their head in the sand and tells people not to worry about it. Don't predict, hey, well, just go into this now and, things have not changed, because they have. They could roll back, but be honest about the information that you're sharing and what's going on. You don't have to create panic. But you do have to share the information. And the reality of it is the people who were sitting there on refis may come flying off the sidelines, because those people that you talked to who were at 5 and waited at 4 and then waited at 3 and were hoping to get into the ones may now come calling to you because they realize something happened to the market and they want to get it in and get done before things go any higher. So we're not in the prediction business, we're in the loan business. Okay, share the information, give people their choices, do the math, the facts, telling the truth, showing the math. That's what the customers and referral partners need. And again, you don't own where the market goes, but you do own your professionalism in this circumstance. So be the professional, do the math, tell them the truth, and let's put them into a position where they can take advantage of what still is a great rate environment. Take care. We'll talk to you again next week.